Hi everyone, welcome to this Natixis research session on our outlook for next year, 2023 outlook. Many subjects to discuss, many uncertainties, but to be honest, we have uncertainties every time we do that for the year ahead. So this is no different this year, obviously, with all what's going on. So what we are going to do is quite a classic feature in this now traditional event. Starting with the macro picture, we are going to discuss energy. I think it's very much at the name of the game, still on a bit for inflation or for GDP growth. So in energy, we are going to discuss that. We are going to discuss Europe. We think as well China is going to be very, very instrumental into next year profile of growth worldwide, but as well for energy, for many things. So we wanted to discuss with you around China. So first macro event, moment together. There, do not hesitate to ask your question. That's a good thing about being remote, is to have this Q&A session maybe more easily. And after that, as usual, we will be moving towards a more specific and market-oriented bit strategy, rates, and a bit of a focus on real estate, which is we have a lot of questions from you and most of the clients are asking us about that. So we are going to discuss as well real estate this afternoon. Maybe to start with, to give you the big picture that we have within research at Natixis, is clearly one of a big slowing down. 2023, no question. If recession, yes, recession probably. The question is by how much, and in that regard, we are more inclined to think about the stagnation more than the true recession. Recession is a sense that we are going to see 2 consecutive negative quarters of GDP, but at the end of the day, you can see that we are going to be next year, at the end of next year, slightly, but still a bit ahead, above current levels of GDP. So it's not 2023 big or even a medium recession. It's more a mild recession, let's put it that way in that regard. And this is a global phenomenon once again. It's going to be concerning both the US and Europe and bulk of the world, and the world GDP will be decelerating fast toward 2%. But this is a global phenomenon. The exception, and this is why we are talking about decoupling, might be China. And once again, we are going to discuss that just after. Global phenomenon in the sense that it concerns as well the US, which is maybe where we are a little bit out of consensus. We are quite negative on the US economy, and we expect 0.6 only of GDP growth next year, for the reason that we see a very coherent policy mix in the US, where you see the monetary policy being very, very aggressive in its tightening mode, something we have not seen since the 70s. In fact, 400 BPs already, and probably 50 BPs more next week, and another 50 in our view going forward in February. So the terminal rate is going to be around 5%, which is already having significant impact on the economy, and we see that in the real estate market, for instance, and we see all indicators pointing towards deceleration, if not more than that. If you take a city like San Francisco, prices are down 10%. That's not something we have seen until 2008. So it's something. When we look at the tightening on financial conditions, with mortgage rate at some point above 7%, we have seen that the credit demands for loans was down by 70% at some stage. So a big tightening. If you look at M2, it's a biggest tightening of monetary conditions since 1959. Well, lots of indicators to see that the monetary policy is starting to dent into consumption, like I said, in the real estate, but as well consumption. One of the reasons why the US economy resisted well this year, around 1.8% GDP growth on average, is probably because the consumer in the US was, taking on one side on its excess saving, post-COVID excess saving, but it's going to be over in 2023, so no more excess saving in the US, so the consumption will be more stretchy on that matter. And the second thing that the household was doing is to have some credit to compensate for this negative, in fact, purchasing power. 20 months in a row of loss of purchasing power, because you have, yes, wages up by 5% in the US, but at the same time, you have inflation up by 9%. So we are a bit below that, but still inflation is much higher than wages in the US. So the purchasing power was losing some stream in the US. So very much impact on the financial side due to the Fed action in the US. And on the other side of the policy mix, on the budgetary side, we see that we don't expect much after a split Congress and ahead of the US presidential election in 2024. So we don't expect much. And if we compare the spending, the public spending this year and next compared to 2021, we are talking about a severe restriction of budget spending compared to 2021. We're talking about 9 points less of GDP. So a massive deceleration of spending, despite the fact that we have seen the Inflation Reduction Act, a very powerful instrument. We talk a lot about that in Europe in terms of competitiveness edge, in terms of World Trade Organization compliant or not, lots of discussion, but still, despite that, the bulk of the public spending is reduced quite significantly in the US. So for this reason, we expect the unemployment rate to go up in the US by 5.5%, and we expect the US to be no exception in this big slowing down that we see in 2023. So I don't want to spend too much time on the US, but we wanted to give you the big picture, which is 2023 is definitely, the slowdown of the economy is ahead of us, and definitely, I mean, at the end of the day, 2022, surprisingly, despite all what happened with the war in Ukraine, with this energy crisis, with lots of things, the zero COVID policy in China almost in recession, despite all this, we have seen that 2022 was quite good in Europe, more than 3% GDP growth. We are going to discuss that in a minute with Dirk Schumacher and my colleagues here at the table. So starting with Cherel Hancock. Cherel Hancock is going to talk about energy, followed by Dirk Schumacher, our head of European macro, and Alicia Garcia, Herrero, our chief economist for Asia, to talk about Asia in general, but more specifically on China, where a lot seems to be going on. But starting with Cherel Hancock, our senior analyst on commodities, one of our true specialists on gas and oil, and we thought it was quite interesting to have his views. As you know, Cherel is among the top 3 best forecaster for oil, so we have some specialists within Natixis research to talk about oil. And what's going on? So, Cherel, regarding oil markets, are we going to go through this winter quite easily, and next will be more difficult? Or what's your view about the oil situation this winter and next?
Yeah, so in terms of the oil market, we generally say that it's cyclically weak and structurally strong. So typically, we class the oil market as the one, or the commodity market, most exposed to broader macro dynamics, and that means that effectively the slowdown, recessionary concerns in the West, the continued lockdowns in China have weighed very heavily in the near term. But we do think that the supply side of the oil market remains relatively constructive. So a big part of the reason why prices came down so much in the second half of 2022 was the announced strategic stockpile release from the US. About 180 million barrels since April have been released. We don't think there's the capacity to actually release that much oil in 2023. And so when we actually turn then to flowing production, so growth from US tight oil, perhaps OPEC, that looks very constrained as well. So when we add then on top of that the potential to lose Russian barrels, we start to look quite tight. Now, right now, the demand side isn't particularly strong. It's not exposing that tight supply side, but we think if we do start to see, consumption pulse on the oil side, potentially emanating from kind of the end of lockdowns in China, then that tightness on the supply side will start to be exposed, and we'll see higher oil prices. So in our base case, we see, kind of persistence of around about the current price level in Q1, Q2. But then in the second half of 23, we do expect oil prices to be back above $100 per barrel.
What about the effect of the oil cap on Russian oil at 60? Is it something of a game changer, or you say, well, at the end of the day, it was already priced in and it doesn't make a big difference going forward?
Yeah, I think ultimately the policy started out highly ambitious in terms of capping Russian oil about $30 to $40 per barrel, seen really as Russia's cost of production and really kind of diminishing Russia's ability to finance its war in Ukraine. It's actually now being proposed at 60, and ultimately the driver of that is to attempt to keep Russian oil on the market. So effectively, we're not going to see too much impact, because when we actually take discounts into account in terms of the cost of actually moving Russian oil now using non-Western shipping and insurance, it is around about $60 anyway. So it's not really going to have too much impact. We think the EU embargo on Russian crude will have more impact, given the fact that Russia is going to have to reroute about 1.2 to 1.3 million barrels per day of crude.
And what about gas? We have seen that we now well above the average in terms of stocks, and everybody was saying it's impossible for Europe to be fully stocked with its gas before the winter. At the end of the day, thanks to mild weather, but probably more than that, thanks to diversification, because it was even before this nice October warming that we have seen. What about gas, Joël? Do you think we are going to end up at next winter, well, depending on the weather, obviously, but do you think it's credible now to do without oil, gas from Russia going forward?
See, right now, I mean, almost everything has gone right for Europe in terms of gas market fundamentals. So the very mild start to the winter with temperatures about 3 to 4 degrees above seasonal norms through October and early November. And also, I mean, the weakness in China, we have to talk about that in terms of LNG availability as well. So Europe's been able to maintain a very strong LNG increment. So, I mean, in our base case right now, we're looking at about 48% storage fullness by the end of winter, which is a lot better than where we thought.
Yeah, because where were we this year? At the end of this winter, we were
about 18 to 20%, so a lot lower actually.
Better.
But the problem really is building stocks without Russian gas. So if we think about 2022, we only saw large-scale Russian flow cuts in June with the Nord Stream 1 outages. So that was about 5 months of Russian inflow that did help to build stockpile. So ultimately, we think that Europe has a lower capacity to build gas storage in 2023. And that means that we're going to have to continue to optimize fundamentals, so curtailing consumption in households and industry, and also attracting marginal LNG, perhaps with more competition from China. And that means the continuation of high prices.
Is it fair to say that the build-up of stock of gas was done while the diversification has not happened yet last year, in a sense that at the time of the invasion of Ukraine by Russia, we had 40% of our gas imported from Russia in Europe, and now it's down to something like 8%. So I think the situation as well might be more favorable in this sense, as long, and that will be a question for Alicia after, as long as China demand for LNG is not competing with Europe. The situation seems to be a bit different, no?
Yeah, I'd say it all depends on the cost structure of our replacement imports. So generally, I mean, Russian pipeline gas was monopolistic to an extent. I mean, there was only a few off-takers, contracts were agreed bilaterally. You compare that to the global LNG market, which is far more competitive. If we do have a relatively weak supply growth in 2023 and 24. And so if that emerging demand does come back from China, from other North Asian economies, then we will have to pay more to secure those cargoes.
Another aspect, probably to see if we have seen the peak of the energy crisis, probably with electricity. And we had a huge problem of electricity and nuclear plants in France. At some stage, we had 32 nuclear plants out of the grid, out of 56. So a massive problem for France, importing electricity for including Germany, UK. That was a very brand new thing to see France importing electricity from almost everyone. It's fair to say that probably, and that's the case today, and we have only 20, if I may say only 20 nuclear plants off the grid. So probably going into next winter, we will see more electricity than we had to produce energy in France that we had this year. So it's why we have this a bit of an idea that it's not normalization. I don't know what's your number for TTF and if you can repeat our numbers for next year, but it's not a normalization in the sense that we are well above the pre-war levels of oil and gas, but we are well below levels we have seen at the peak of the energy crisis last year, in a way.
So just quickly, so our base case forecast for TTF is between 130 and 140 euros per megawatt hour. We think that ultimately gas prices have peaked, but we will now have a plateau until we can diversify demand away from natural gas and also have more LNG supply into the market.
So it's not normalization, it's a less worst situation, let's put it that way. Thank you very much, Joel. So what about Europe in this context? Is it going to be a lot of, well, sometimes non-European as well, more than the rest, but still a lot of our competitors are expecting a big recession in Europe in this context of the energy crisis lasting for a couple of years, probably, it's fair to say. What about our scenario, Dirk?
Well, our scenario is a moderate recession, meaning 2 quarters of negative growth, 1% decline in GDP in total, but for the year as a whole, we still have 0.3 as a growth forecast. So it's not the mother of all recessions you could see given the shock, the energy shock, given the income shock. And the main reason is that governments have stepped in and put a lot of money on the table, are willing to help corporates, households, and that will buffer the shock significantly. I don't think we can evade a recession, but it's not going to be a deep one. At least that's our forecast for the time being. And the data so far remain consistent with that. If one looks at the latest business survey data, they actually have improved a bit. They're still signaling a recession, but not a further deterioration compared to, say, 2 months ago.
What is really impressive is to see to do a little bit of link between the two subjects, is to see that the energy consumption in Germany, I think, is down like 20%, and still industrial production is revised upward, in fact. So it means that so far, it's not so far so good, but we are saving energy more than cutting production. Is it something which is going to last?
Well, you see sectors like the chemical industry where production is down sharply, but you see other sectors like cars where pent-up demand, and finally the semiconductors are being shipped again to the industry where production is rising. So net, up until now, production has held up relatively well. But again, given the accumulation of all these shocks, I think we'll see also industrial production now declining, not least because orders have come down for a couple of months now. So again, recession should be the baseline, but not a very deep one.
What about budget? I was mentioning budget for the US, which is a bit of a restrictive budget. We see in Europe that we are spending like mad, in a sense, to buffer this energy shock. I guess it's difficult to imagine the big recession in Germany when you put 200 billion on the table.
Indeed. That money will not be spent optimal in a sense that it will reach everybody or every company right at the point in time it needs. So there are frictions, but the money is enough to again, shield the economy for any deep deterioration in the economic environment. That was the purpose of all it. Inspire confidence, say the government is there to help, and the numbers presented are certainly big enough.
What we have seen in France is with 43 billion of spending, you have seen an inflation cut by 3 points compared to the rest of Europe. So we can imagine some kind of a significant effect from this freeze of electricity and gas prices in Germany, probably.
Well, they won't be frozen like it's in France, but there will be transfers whenever the prices reach a certain level. So it won't have the direct impact on inflation the way it had is in France, but there may be an indirect one. So it still helps in the whole disinflationary process, though the setup is somewhat different.
So in all, maybe we can, my question would be on inflation, but if we see energy prices going down and inflation going down, we can expect some kind of a regaining, that's a bit of a paradox, but regaining some purchasing power. Where do we see inflation going next year?
Well, we have it peaking now, fourth quarter, and that is because the energy side will help quite significantly and because supply chain problems will ease. We see that already in the data. Those were the main drivers of inflation. If they improve, that should have a meaningful impact on inflation. On top of that, we have a recession, though a mild one, meaning output gap is rising, disinflationary impact from that side as well. So we probably have the worst behind us, barring any new energy shock. We have inflation going to around 3% by the end of next year.
With this inflation probably a little bit persistent than in the US, with the energy crisis a little bit more, since we are net importers compared to the US of oil and gas, which are a net exporter. Do we see a risk of disindustrialization? I've seen that Iberdrola is spending twice as much in the US than in Europe. We see like companies like Safran waiting on Norfolk, on batteries, waiting on the sidelines to see where they put their money next year. Do you see a risk of disindustrialization of Europe in this context?
Well, there's certainly a risk and a lot of announcements from corporates to move to the US because of that. But you can also see that as a kind of cry for help in the sense that we need money as well. So I would not take that at face value. These surveys showing that half of the companies will move, but we'll probably lose some of the energy intensive industry. I'm afraid it's inevitable. Because until renewables will fill the gap, it'll take a couple of years. And given the money in the US, and given that Europe will provide some money, but probably not enough, we lose some sectors here, I'm afraid.
Since you spent some years as a lead economist within the ECB, I cannot but ask you the question about the ECB. Where do you see ECB if we have peaking inflation around here, but we still see inflation around 3% at the end of next year? When do they stop?
Well, we're a bit more dovish than the market. We think in March at 2.5% for the deficit rate. And the main reason is that A, inflation is coming down, but B, that the ECB is tightening along several dimensions at the same time. So TLTRO money repayments, but also quantitative tightening. If you put all that together, you have quite a significant tightening probably on top of what has already happened. So the need for aggressive additional tightening, I don't see unless wages were to accelerate significantly, which we don't expect, and or inflation expectations were to move up in a meaningful way, which again, we don't really see and don't expect.
Maybe it's a good time to move to China, because on one side, if China is re-accelerating, that's good news for Europe, especially a country like Germany. Lots of his export now is depending on China. On the other hand, probably if China is rebounding, as we know, China is importing 25% of the world energy. So probably, Joel, gas and oil prices will be impacted. LNG will be more of a competition going forward. What do we say about China? What's going on? Is it a true reopening of the economy?
I'm afraid so. So I'm sorry, Joy.
It's good news for world trade.
Actually, I think it's bad news on the energy side for Europe that China is reopening, but I'm not sure it's good news for Germany either, because China is going to reopen massively domestically, but I think it's going to be very cautious to end up having a big trade deficit. And the reason is that China is still in kind of a war, war model of, economy, because the U.S., for China, the U.S. is a real threat. And therefore, this idea
the other way around works as well.
Yes, dual circulation, substitute imports, move up the ladder. I mean, all of that is still there, no matter whether they open or not. It was there before COVID, it's going to remain there. And I think there's been already a lot of import substitution. Clearly, if you look at what China is importing, is mainly commodities. Machinery has slowed down significantly, partially, of course, because of the slowdown. But I think more structurally, China is ready to substitute as much as needed. So in that regard, it's a double whammy. Although, of course, it's good to know that there will be a big country in the world that will be growing more than in 2022, because that's going to lift growth generally. But the benefits of that growth in terms of imports, I think, are going to be limited to commodity exporters, mainly.
We see a lot of evidence of the end of the globalization as we knew it, in a way. Every day we have seen that. We have seen that in the UK of late, taking out some Chinese corporate out of nuclear, or in Germany with some semiconductors. We see that every day. We see that with the Inflation Reduction Act in the US as well. In a way, it's a kind of a trade war with China in the making. Is it not something of a weakness for China going forward? And we see Foxconn or Apple moving some production out to China, from China to India or to Vietnam. Is it not a threat, in your view, going forward?
Well, there is indeed reshuffling of value chains, partially away from China, simply because the concentration was humongous. So, what we call the centrality, China's centrality in the value chain is a real issue, which in a way has only grown in the last 15 years or so. And it's being reshuffled away from China, but not fully, because China remains a very large market. So when Apple says, I'm creating a second plant, it's a second plant, and it doesn't have to be the main plant. Samsung did actually nearly fully, the operations in Tianjin are very small, move away from China in 2008, but that was conscious and partially because of economic security reasons, because at the time If you recall, South Korea was really at risk because of THAAD, the anti-missile, U.S. anti-missile placed in South Korea. And South Korea understood that any excessive leverage, China's excessive leverage on South Korea would have harmed Samsung or other major South Korean company. So that's where I think we're not yet there in Europe. But I do see smaller companies in Europe, including German companies, thinking twice. It's the largest companies that are staying because lots is at stake, isn't it? I mean, they are very big.
If you're Tesla or Volkswagen, you're
right. So it's not a full reshuffling. It's a partial reshuffling. Newcomers are no longer considering China as the best and only option. I think that's the way we are seeing. And those that are strong enough, say Apple, are looking for second options, but not only second options. So that's where we are. So yeah, and I don't think it'll be reshoring to Europe mostly. It'll be
but probably a chance for India or rest of Asia.
Yeah, correct. So it's India, ASEAN.
And if we move back to the domestic situation in China, because we see a lot of hope in this reopening of China, as opposed to what we were saying in a way after the Congress of the Communist Party to say, well, Xi Jinping talked about 190 times of sovereignty, security, and only 4 times about economy. If the next prime minister is the mayor of Shanghai in March, maybe it's not a good sign for economy, and we see that with education, with tech, with luxury, and so on and so forth. Do you think there is a true change, a U-turn from Chinese authorities?
There is a U-turn, which is frankly quite unexpected for the reasons you mentioned, but it's because the level of risk of maintaining zero COVID has massively increased on 2 grounds. The economy we know, because that was already there, but student protests and, very importantly, workers. This is the so-called closed-loop strategy, where you basically lock people, in a factory, as was the case of Foxconn, but many others, and you keep them there for months, and that's unsustainable, obviously, as we've seen with Foxconn. So, the combination is a lethal combination for any autocratic regime to have both students and workers, coming together. So I think that has clearly, open the kind of the door to full exit from zero COVID policies. Let me tell you that doesn't mean there are no consequences, social consequences, because China's vaccination rate is extremely low, especially for elderly. So that's where we are. But I guess there wasn't much choice, because the vaccination rate, by the way, has been stagnant since 2021. So in that regard, I don't think China was getting ready to open. China has been forced to open, which is a very different scenario. Thus, that idea of economy of war and keeping, your trade surplus and being ready for the worst will remain. So it is an opening. It's nice, but it is not the type of opening you would have had if China had been ready in terms of vaccination rate. That's not what we have now.
Yeah, that's all the concern about the speed at which you can vaccinate a 1.3 billion population, and with a kind of efficiency of vaccine, I guess, doesn't. Well, we are back to square one if we have some variants and so on and so forth. So the situation is quite complicated, I guess. And what about the numbers that we expect for a little bit beyond 2023, 24, if we think a bit more long term for China?
So we obviously had to, over the weekend, change our forecast to a higher growth for 2023, given that even mass tests are being lifted now in China, and there's no PCR requirement for any public space. I mean, it's changing as we speak, and therefore we've moved up our forecast to 5.5, which is still much lower than 2021, meaning we recognize, with that number that China can't grow as fast anymore because it's in a structural deceleration, to your point. And therefore, 2024 will be even lower. I mean, 5.5 is actually a good growth rate based on a base effect. 2024 will be lower, 4.5 in our view, and then increasingly lower because that's the structural deceleration, maybe not just a line, but somehow getting to around 2% by 2030. 2% by 2030 means that China will be normal, but China won't have the income per capita of South Korea or the US or Europe. So it will be normal before time, if I may say so. That means that China will stop converging with the US by 2030. China might be bigger than the US by then, depending on this COVID exit strategy, which will help, but marginally bigger if at all. And I guess we'll have two lines of, basically two major economies in the world growing about the same, which means that strategic competition will continue for ages, won't it? I mean, there won't be like a major economy dominating, yeah? So it's a very, very different world from what we have had for decades, yeah.
And probably some other competitors are going to gain ground, like Indonesia or India, no?
Yes. The thing is that we'll have middle powers, yeah, obviously, and Europe will be a middle power, because by then our GDP, and let alone the fact that we're not clearly a hard power, will put us together with India, with maybe South Korea, Japan. I mean, that kind of bunch of Brazil, middle powers. And I think that's where Europe should be placing itself in terms of strategic agreements, moving away from this strategic competition between the US and China, because it's going to last for so long. Yeah.
Very interesting. Thank you very much, Alicia. We have if you have some questions, do not hesitate once again to use the Q&A. We have one question regarding the US, what will be the factors of US CPI the most affected going forward, housing, food, healthcare. What we have seen of late in the US CPI, especially in 2022, is a major impact of housing, food obviously, but if you take housing and used car, for instance, you had some very good leading indicators of inflation, and looking forward, looking for 2023, used car is down minus 15%, for instance. Energy prices, we mentioned that, they are not going to normalize, but they are going to be much lower. Even for food prices, if you took wheat prices down 40%, coffee is down 28%, rice prices are back to November 2021 level. So we're probably going to see second round effect. Today we have the first round effect of food prices into processed food, but at the end of the day, it's going to be impacting the CPI as well in the US to answer the question. Thank you very much to all the three of you. So if we conclude on our macro picture in a way, you see it's a little bit more optimistic or less pessimistic view regarding the European situation. First, on the growth, GDP growth, as Dirk mentioned, it's going to be still higher end of 2023 compared to end of 2022. Like Joel said, the energy crisis, the peak of the energy crisis, in a way, is behind us. It's not to say that there are no challenges ahead. It's the green transition is accelerated like never before, and we see that every day. Germany has just put to work 1 gigawatt just in September only. We see a lot of electrification accelerating. Germany again, 54% of electricity is done with renewable energy, so it's moving fast. But still, the challenges ahead are very, very big, especially for China. And this is our scenario now, to see China again the engine of growth next year. Three quarter of the growth of world economy, will be coming from Asia, and China will be playing a big part of that, which is a kind of a new thing. So a little bit of optimism in this scenario. Recession, yes, but we call it mild recession, if not stagnation, instead of a true recession. Thank you very much, Alicia and gentlemen. Thank you very much. Welcome back. So we continue with a kind of more practical way of looking at these things on a market perspective and asset classes perspective. So I'm very happy to welcome Ina Mufteeva, our credit specialist, Thibaut, the head of our sector research, Cyril, the head of our market research, and our new analyst, Cherel, on real estate. So maybe we start with Cyril on the top-down analysis in a well. Thierry, Cherel, sorry, I was wrong in my name. Cyril, first thing first. What about the Fed, ECB? What's your scenario in that?
Well, I think you discussed a bit with Dirk our view on the ECB. So we are expecting the ECB to stop at 2.5%. Its deposit rate, so a bit more dovish than what the market is expecting. A bit different for the Fed, on which we are rather aligned with market expectations, which are already quite aggressive, not in terms of monetary tightening, I would say, but probably in terms of monetary easing towards notably the end of 2024.
Interesting. And regarding the ECB, do you think that in this context we were mentioning with Dirk, with inflation peaking, yes, but probably at very high levels today, we are still around 10%, probably something around 3%, Dirk said at the end of next year. How do you think that the ECB can justify stopping at 2.5 is the deposit rate?
Well, that's a good question. Of course, when we get on a daily basis, so the tightening we have of financial conditions in Europe is a important thing, of course, and alongside, of course, the increase in deposit rate we're going to have, we have to mention QT, so a minor tightening in terms of expectations not only into the next year, but the big elephant in the room is going to be the TLTRO, because we are speaking in this regard of a 1.8 trillion euro drain, liquidity draining, so a massive, quite massive, in fact, decrease in ECB's balance sheet.
We had 300 billion, 396 billion to be precise on November. What do we expect? Let's take a guess for December. Sorry to ask you that. Huh?
It's a good and tricky one. I would tend to say our expectations is of 500 billion euros repaid by the 21st of December.
So that's a massive, not tightening on financial condition for sure, but clearly a massive reduction of the balance sheet of the ECB. A lot of people are questioning how fast it can go, but at the end of the day, the ECB is going faster than the Fed in this regard.
Absolutely, way faster. While the Fed will be reducing by 1 trillion. The ECB will do 2.5 trillion euro reduction, so way faster in this regard. And it's going to have, I think, an effect on the bond market. Our view is that the US bond market will probably outperform the European bond market into next year, because we have these very strong rate cut expectations on the Fed. The market is already buying this story of the pivots. And all technical, let's say, measures of the ECB, TLTRO, disappearance, plus, of course, the QT, will have an impact on yields, which are expected to remain stable during the course of next year. So 2 targets. For the 10-year US Treasury yield by the end of next year, it's 3%. And for the 10-year bond, stability will be the name of the game, with a 1.85% bond by the end of next year.
If we are right, and the Fed is very close to be pivoting in the sense that that will be the end. They have done 4/5 of the move already, and the next move after that, we don't know when, but it will be a cut. ECB, if it stops at 2.5 in the first quarter, does it mean that we are going to move from all this inversion of the curves toward a bull steepening of the curve at some stage? No,
definitely. We are expecting, in fact, for example, 10-year UST's yield to drop by 60 basis points into next year. The 2-year yield is going to drop by 120 basis points. So yes, we do expect curves both in the US and Europe to re-steepen quite a lot.
You mentioned swap spread and sovereign spreads. What about Italy? We talk a lot about BTP. It was a good way to short Europe, and we have seen that with the euro being very, very weak against the dollar. And we see a bit of a reversal with this risk-on market that we have seen of late. Where do we see the BTP boom going forward?
Well, we see BTP Bund peaking around 240 BPs by summer of next year on the back of course, the TLTRO story and, of course, the QT of the ECB. But things should retighten afterwards as we expect risk appetite to recover during the second half of next year.
Any concern regarding Italy overall? Or?
No sustainability issue so far as Giorgia Meloni is of course following the steps of Mario Draghi, and she needs of course the cash from the EU, from negotiation EU, still talking about 190 billion euros, and Italy needs it in this very, very challenging market context.
And the good news in a way that Europe matters in this sense that Italian government has to comply with the agenda of reforms every quarter. There is a bit of an assessment of that, so it's probably why the market is buying some BTPs more than anticipated at some stage. There is no big political risk out of Italy as we could have been afraid of at some stage. What are your other major calls for 2023, Cyril?
So we'll keep having a tightening of swap spread, of course. Linkers and inflation metrics should drop a bit or cool down alongside the disinflationary pressures we're expecting. And that's it. Long USTs, of course, in a context in which the Fed will do its pivots. It's an interesting strategy for next year.
In this context, any word on your team call on FX? I'm thinking about the euro, and we see a strong rebound. I was mentioning this maybe unwinding of short of Europe through BTPs, but maybe it's not that. What about the euro dollar?
Euro will get stronger next year. For two simple reasons. Risk appetite will recover, which should translate into a weaker US dollar. And of course, we're going to have a tightening of spreads between US and Europe, which is once again pleading in favor of a stronger euro. So 110 will be our target for the euro dollar in 1 year.
But it's fair to say probably that that's not the end of a strong dollar, but all these unbalances that we have seen out of the strong dollar for emerging, especially if what we mentioned with Alicia just before, if China is rebounding, probably the weighted dollar is going to decline a little bit, and that will be another reason for optimism. As well, I'm just taking en passant, I'm just thinking that a stronger euro will be another factor towards the disinflation in Europe in this regard. Very interesting. So thank you, Cyril. Maybe, and we have some question regarding credit spread, Ina, so it's directly for you. So without further transition, what about risky asset in general, and maybe moving to credit after that, Ina? We have seen a massive rebound on risky asset. I'm talking about stocks here, with more than 20% above that even since October. So we're entering a bull market, and we've seen the major indices totally erasing the losses due, well, as if no war, as if no energy crisis, as if no strong deceleration of growth. Is it a good time to buy back risky asset, Ina?
Yeah, hello. Hello, everyone, and thank you for being here. It's funny because I remember like some months ago, we were sitting in the same studio and discussing the same question, and our call was, wait until the end of the year. And here we are, almost at the end of the year, and we still think it's probably not the best point to buy the risky assets, well, at least most of them. So why is that? As you just mentioned, those several episodes of market rallies, in fact, send the risk asset valuations so high that they just don't seem cheap anymore. They just don't seem, they're just too expensive. Take the US market, the US equity market, for example. If you look at the 12 months forward price to earning ratios, they are close to, for the Standard & Poor's index, for example, 500, they are close to the historical highs, well, at least they're in top 25% at around 17. So considering our scenario of economic recovery after a mild recession, but still quite a sluggish recovery, the earnings perspectives are pretty grim. So we even actually expect 0% growth for earnings. And so with this 0% growth for earnings, the only way, in fact, for the US market, equity market to perform will be to expand the multiples. And as they're already so high, we don't really see any potential at all. So in this way, we're clearly preferring the European equity market, which is not at its top level in terms of the PER ratios, and might still see some expansion of the multiples, despite the sluggish growth in earnings.
And if you had to take a guess, when will be a good time for buying back? Well, you're mentioning credit, but equity, but.
Well,
timing.
Yeah, we will go back to that. I would just like to mention another case of quite a strong mispricing of the market, which is a high-yield credit market. When we look at the break-even spreads, those spreads which are net of the default risk, they're at negative levels actually currently. So it means that they are not pricing enough of the default risk, while if we look at the forecast of the economists, of the rating agencies, everyone is seeing at least the doubling of defaults in 1 year. We're seeing a bit more than doubling. Well, probably not 4 times increase that Moody's is actually seeing in their pessimistic, moderate pessimistic scenario. But it's quite a significant increase in the default rates, and we already see some signs of credit quality deterioration. So clearly there is some mispricing in the high yield market, and we are therefore having preference for the IG. As for the timings, just as you mentioned, we think that the Q1 will be quite weak and a difficult quarter, but probably afterwards, with a bit less uncertainty on the trajectory on the inflation, with the confirmation probably of a mild character of a recession, and expectation of the further recovery, especially the expansion of the recovery in 2024, we might pass in a mode of anticipating a bit better times than what we've seen in the past year, for example. So that's why we're actually seeing relatively good performance in the risk assets, should it be equities or credit. So we see some spreads tightening, especially in the IG, as just I said, because well, high yield is already quite expensive. And in terms of the equity market, Europe indeed has a bit more potential as well.
So, Ina, what will be your major calls for 2023?
Well, so as I said, Q1 very weak, but a bit more decent performance for the rest of the year. Tightening in spreads, a bit stronger on the IG side, well, in terms of the multiple compared to the high yield, so preference for the IG, and preference for the European equity market versus the US one.
Thank you, Ina. Once again, if you have questions, do not hesitate. We move to another asset class that we like a lot to look at, and it's why we have a new asset in the team with Thierry Cherel joining the team on real estate, and Thibaut Cuillière is more than happy to have him on board. So Thierry and Thibaut, and we started to see the impact on rising rates, maybe for you, Thibaut, at first, on the impact on rising rates on real estate. Is it starting to dent into this asset class?
Yeah, hi Jean-François. So indeed, actually, we are starting to see the impact of rising rates on real estate, and we can say that there was no place to hide actually in 2022. Even the residential market, which used to be the safe haven of real estate during the COVID crisis, has actually been affected. In residential market, we have started to see some decline in house prices where there is more dependency on variable rates in the mortgage, or where central banks have been hiking faster, such as the UK and the US. For instance. So if we take the example of the US, we have seen already -3% of house prices over the past 5 months, -2.5%, -3% in the UK too. Now, when it comes to...
I heard -20% in New Zealand is expected, so yes, it's starting to show.
Exactly. This is a good country, actually, a good example of country where there is a share of variable rates which is much higher, and as a consequence, the impact is much faster on the house prices. Now, when it comes to commercial markets, as you can see on those pictures, actually what we see, interestingly, is that the premium attached to the yield of real estate market compared to the 10-year rates is actually moving to something very close to zero if you look at the office market, for instance, while the historical premium over the past 20 years is more than 2 points, which means that today there is no more illiquidity premium attached to the office market, and as a consequence, valuations have started to decline by 1% in Q2, almost 5% in Q3 for office.
Yeah. Interestingly, on these charts, on the right-hand side of the presentation, you are seeing also the retail property sector, which is closer to the historical premium, which is a pretty more comfortable valuation, it was the case. The premium before entering the current crisis with rising rates was way much higher at the beginning of the year, and now it's pretty comfortable level, which explains the fact that the market price has declined only by 3% over the year, so year to date, which compares pretty well with the 3-year performance with 30% decline, of course, with many impact from the COVID crisis and many several lockdowns, but also the rising in market share of e-commerce. And on the other way around, you mentioned a U-turn in this cycle, and when there's a U-turn in the property markets, the former winners become the losers, and currently former winners was the logistic property sector, benefiting from the e-commerce market share growth, which is completely stabilizing right now, and we are seeing just in the last quarter, the Q3 2022, a decline of 6%, just after a pretty decent growth up until the Q2 2022 of 21% year over year. So this shows a pretty huge return of this market, and we expect maybe worse to come over the next year.
So we see major changes, rebalancing on one sector to the other. What will be, on your view, Thierry, the segments the more affected in this context?
Yeah, maybe at first important to mention the lag between what we are discussing right now, so the market dynamics and the price on the market, because property deals happens and then it serves as a reference for the fair value portfolio and valuation, and then reported in the company statement. So there's a lag here, and as we see that there will be much worse picture for 2023, except maybe for the retail property sector, which will remain pretty resilient before of the valuation, but also because of the market rent, which have decreased over the last years, but maybe are right now at a more affordable level. And that's the direct impact of the stabilization of a market share on the online sales. There's not much competition coming marginally, and this is pretty good for rent stabilization for retail. So retail, we expect 25 bips of decompression, which is pretty decent at a level pretty high, and market rent pretty stable. For the logistics sector, which is one sector which will be hurt, as I mentioned, I think worst is ahead of us, maybe such as the office. Thibaut could say a word afterwards, but we expect 10 to 15% drop in market price, taking into account that the fact that market rent will decline, will grow by 5 to 10%. Grow because the fact that the vacancy rate in this market is pretty low, so this is a very undersupplied market, so sensitive to even a small level of demand.
And interestingly, to complete on what Thierry mentioned, actually for the office market, we are expecting also a decline of 10 to 15% in the valuations. We actually developed some econometric models in order to capture what should be the cap rate for the various office markets in Europe. And as you can see on that picture, you see that for the Paris market, for instance, we have already seen 30 basis points of increase in the cap rate, but we believe that there is further to go, probably 45 to 50 basis points of further decompression for the cap rate in Paris. Now Paris will actually be better protected than some other cities. We did models for the other cities that you can see on the picture right-hand side, and we actually believe that given the trend we have seen in rates, but also the fundamental dynamics of the various office markets in Europe, some segments will actually be even more exposed to that new dynamic markets, such as Barcelona, Milan, Madrid, or London, for instance, where we would expect a further decompression actually trend compared to what we see for Paris, Berlin, Munich, and Lisbon, which probably will resist a bit better on the office side.
Any further element on the real estate company and rate bonds, for instance?
Yeah, so interestingly, what we have seen in parallel to that, obviously, is the fact that the real estate market and the bond market has been really massively underperforming with minus 17% of total return year to date compared to minus 12% for the overall credit market. And this is largely due to the fact that the companies there are much higher leveraged than the rest of non-financial companies. And given the increase in rates, they are suffering from pressure on the coverage ratios.
Yeah, and it's coverage ratio directly linked to the refinancing risk, and companies are proactively taking into account this risk and trying to settle new strategies, such as the one of LMEs done by Vonovia recently, or Unibail securing financing with Allianz on the largest shopping center in Germany, Centro. And recently, with the announcement of the trading update of Around Town, they mentioned they won't call the hybrid bond and also keeping the possibility not to pay coupons or even dividends, which of course is it's a surprise for the market. It's disappointing for subordinated debt holders, but for credit perspective, for the senior credit rating and also for the corporate liquidity, it's a pretty good discipline, financial discipline, I think.
Lots going on. Maybe to sum up, Thibaut and Thierry, Thibaut, what are your key 3-4 takeaways on the real estate market?
Yeah, so first takeaway clearly is that the worst is ahead of us in terms of valuations. We expect 10 to 15% of decline potentially for short-term valuation, particularly in office and logistics, while the retail and to a lesser extent the residential market will be more preserved to this correction in valuation. So that's the second point, actually, the segment differentiation. The last point being, what do we expect for real estate on the bond market this year? Next year, actually, an outperformance. If Cyril is right in predicting that rates will actually stabilize and go down on the long end of the curve next year, it should actually help an outperformance of real estate due to their very high beta in that rate environment.
We have a question maybe linked to that, and that's for all panelists. How does the expectation for growth of default rates, especially on credit, you mentioned, Ina, is coherent or is linked to the euro strength that, Cyril, you were mentioning? You know what I mean is that if we have a default rate, but I guess the answer is the timing. Once again, is that the first quarter, second quarter, we are quite cautious, but going forward, we expect a bit of a stabilization of spread, and euro will be benefiting for this risk-on environment that we expect for next year, plus the fact that this rate differential is no more in favor of euro. Maybe any comment on that?
So first, just a little comment on the default rates between the two zones that we're speaking about. Well, when we look at the moderate pessimistic scenario of Moody's, they consider that the US will suffer more from the defaults than Europe. So in the US, they expect something close to 11% in 1 year, as against 1.5 right now, while in Europe it should be around 8% or 9% against 2.6 at the moment. So for sure, in terms of the
relative value, euro
relative
is
dynamics in terms of the default rates, if we consider the moderate pessimistic scenario of Moody's, it's the US which is suffering the most. But I'm not quite sure how we can translate it into valuations of euro, but well.
I mean, maybe one interesting angle is that VCB is there to take care of financial stability issues, and if we start having a credit default rates skyrocketing, etc., we'd end up with a widening of credit spread, widening of sovereign spread. In this case, VCB will have probably to change course, maybe activate the TPI, not for a sovereign, but for the credit market, if it's having some troubles. So my gut feeling would tell me that in this kind of scenario, even though default rate would increase way more in the US, you would have probably a central bank intervention, and VCB would, in this case, I think...
It would be back to bad news is good news.
Yeah.
Okay, so thank you all. So if we summarize a little bit our view maybe for today, as you can see on the macro side, at the end of the day, the worst is ahead of us in the sense that 2022 was a good year. It was again close to 3% of GDP growth in Europe, more than 2.5 most likely in France, for instance. So close to 2% in the US. So if we compare 2023 to that, we are talking about GDP growth numbers divided by 2 or 3. The only exceptions being probably China. India is still doing very, very well, but in terms of rebalancing and decoupling in 2023, it's fair to say that the bulk of the economy is still going to decelerate going forward in 2023. That's definitely our scenario. But we do see as well this kind of a reduction of risk due to the energy crisis. Again, this is a long-lasting process. This is not the end of the energy crisis. What we're just saying is that the bulk, the peak of prices for oil, for gas, for electricity is probably behind us. So if we were going to compare in March the level of oil, of gas, and weight on rice, on everything, almost everything, of containers, of ships, of everything, of shipping, you will have some major basis effect. So it's why we expect this inflation to start having this disinflationary trend that we see lasting for all 2023. So meaning for central banks, pivot is already there for inflation in the US that the central bank is going to take into account very soon. So 50 BPs, not anymore 75 for the Fed, followed by another 25, and this is it for the Fed. And probably the ECB, our best guess is for 50 BPs in December, and stopping around 2.5, because what was mentioned by Cyril. Well, beyond rates, you have all this tightening of reduction of balance sheet of the ECB, which is going to be very, very instrumental as well in the tightening financial conditions. And that's going to have an impact as well. And meaning for markets that we are very cautious for the next couple of quarters, if I hear you well. Lots of things to play out in different asset classes, be it in credit or in real estate. But please, if you want some more, we are going to publish a very detailed publication at the end of this week. And you can obviously follow us on the website, on all social media. We will be more happy to exchange further with you. Thank you very much to be to join us today. We were a lot of us today, so thank you very much for your confidence, and talk to you soon.